It wouldn't surprise me if gold took a rest here. Some of it will depend on investor response to the comedy which will unfold tomorrow. But I think in the longer term, unfortunately, gold will do very well. I say unfortunately because gold does well when people are rightly concerned about the maintenance of their purchasing power in fiat denominated instruments. And unfortunately, I feel like US dollar savers will be challenged for the next 10 years. So I feel that gold will do well.
Gold prices held steady on Tuesday as investors awaited the results of a tightly contested U.S. presidential election between Democratic candidate Kamala Harris and Republican Donald Trump. Spot gold remained nearly unchanged at $2,738.83 per ounce, following last week's record high of $2,790.15. U.S. gold futures slightly increased by 0.1%, reaching $2,748.20. The anticipation surrounding the election has heightened demand for safe haven assets like gold, which traditionally thrives in low-interest rate environments and serves as a hedge against economic and political uncertainties. Market attention is also focused on Thursday's Federal Reserve's upcoming interest rate decision, alongside remarks from Chair Jerome Powell and other Fed officials. With inflationary concerns and economic uncertainty persisting, gold has gained 33% this year. A seasoned market analyst, RickRule, remains bullish on gold, noting that its performance tends to strengthen during economic instability. However, he cautions that rising gold prices often reflect concerns about the stability of fiat currencies, particularly the US dollar, as investors seek alternatives to preserve purchasing power. In tandem with gold, silver maintained its position around $32.50 per ounce during Asian trading hours on Tuesday, as cautious sentiment dominated ahead of the election. The uncertainty surrounding the election outcome has contributed to silver's appeal as a safe haven asset. According to FX Street data, silver rose to $32.65 per ounce, marking a 0.44% increase from Monday's level of $32.50. Since the start of the year, silver prices have climbed by an impressive 37.19%. RickRule also highlights a typical pattern observed in precious metal bull markets regarding silver. As silver rallies, its price fluctuations can become significantly more dramatic than gold's, particularly toward the end of a bull market. This phenomenon often occurs when generalist investors, drawn by rising prices, flood the market, reminiscent of previous tech booms. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
It wouldn't surprise me if gold took a rest here. Some of it will depend on investor response to the comedy which will unfold tomorrow. But I think in the longer term, unfortunately, gold will do very well. I say unfortunately because gold does well when people are rightly concerned about the maintenance of their purchasing power in fiat denominated instruments. And unfortunately, I feel like US dollar savers will be challenged for the next 10 years. So I feel that gold will do well, and unfortunately, I mean, I think that's a very bad thing. I happen to be way long. I lived through two representative gold rallies: the period 1970 to 1980, and the period 1999 to 2011. So what's that? A 10-year period and a 12-year period? I think that given that gold responds to very broad macro trends, that in order to participate in the fullness of the rally, that somebody needs to probably be involved in it or anticipate being involved in it for a decade. A different way of looking at it, though, Maggie, is that when some of your younger listeners ask you when gold might move, the correct response is probably 24 years ago, because gold was at $253, if my memory serves me correctly, in 2000. It's at $2,700 today. Gold has moved 8% compounded for 24 years. Or put differently, it's maintained its purchasing power, which is exactly what it's being asked to do. Later in the show, I hope I have the opportunity to explain why, arithmetically, I think gold will do well in the next decade. I'm not prepared nor equipped to tell you how it will do in the next 3 months or 6 months. I don't know. And I have to say, at age 71, I'm not even interested. I think that the hate trade is out of silver. Uh, for people who really like the hate trade, like me, you need to have taken your profits in silver stocks,
Mm.
taken some money off the table. And the generalist investor comes into the market. The first thing that moves are the big gold stocks. When the generalist investor gets more comfortable, Silver begins to move in preference to gold, perhaps because of its lower unit cost. I don't know why. But when it happens, it moves much further and much faster than gold. And by the way, you won't need some tired old analyst like RickRule to tell you when leadership has changed. It will announce itself.
Yeah.
The moves in silver historically have been stupefying. And the biggest move occurs towards the end of a bull market when the generalist investor becomes convinced that he or she was right with regards to the narrative, and plows in to the mining stocks the same way they plowed into junior tech some years ago. When that happens, the biggest upside that you see is in the speculative, the small silver stocks. Again, quoting my friend Doug Casey, when that happens, the market cap among the silver stocks isn't sufficient to handle the influx of capital into them. The financial result is the equivalent of attempting to siphon Hoover Dam through a garden hose. When you see that happen, be very nimble. The backside of the Canadian hockey stick chart is just as steep as the front side, and it's a lot less fun.
RickRule highlights a growing trend among foreign central banks, which increasingly purchase physical gold to hedge against the weaponization of the US dollar and its declining purchasing power. The US government's use of the dollar to advance political goals and concerns over its real value has made US treasuries less appealing to many countries. As a result, nations are turning to more stable assets like gold. Compounding this shift is the recent report from JP Morgan, which indicates that the BRICS alliance is making significant strides in its de-dollarization agenda. The investment bank notes that BRICS countries have largely ceased using the US dollar for commodity transactions since 2022, opting for local currencies and energy dealings instead. This transition reflects a broader trend where new payment systems facilitate cross-border transactions without relying on the US dollar. These developments are gradually undermining the dollar's dominance in global trade, positioning BRICS as a beneficiary of the changing landscape in payment systems. As countries seek alternatives to the dollar, the demand for gold as a haven and store of value continues to grow, further reshaping the dynamics of international finance. Let's get back to the interview.
The statistics say that the buyers of physical gold have been foreign central banks. Until 25 weeks ago, measured by inflows and outflows from physical ETFs, retail buyers have been absent the market. The buyers have been foreign central banks. And they've been buyers for two reasons, both of which seem likely to continue. They are, first, the weaponization of the US dollar by the US government. We are the world's reserve currency. We are the world's foremost store of value and medium of exchange. But the US government has decided to weaponize the dollar, to externalize American politics to other countries. Whether or not you agree with US policies relative to, say, Russian policies is a different question, a side question. The fact is that the US government has decided to use the US currency to further its foreign policy goals, including, in one case, stealing $300 billion worth of Russian assets. You may, as an American, decide that Russia's actions in the Ukraine are reprehensible. Whether you agree with the policy or don't agree with the policy, it is a simple fact that the US government stole $300 billion in Russian savings. This sends a message to all foreign countries that might engage in a policy dispute with the US, which is a different way of saying all foreign countries, that they can no longer trust the United States government and they can no longer use the US dollar as a store of value or a medium of exchange. This is really simple stuff. The second reason is somewhat more nuanced, and your listeners will have to suffer through a little bit of explanation. If you agree the deterioration in the purchasing power of the US dollar is best measured by the CPI, Consumer Price Index, which is 2.6%, you can be calm. I don't agree with that. I think the CPI is best described as the CP lie, in the sense that it doesn't measure for me the deterioration in the purchasing power of the US dollar relative to the basket of goods and services I buy. As an example, Maggie, when it's inconvenient, it doesn't include food or fuel. Now, if we had a broader picture of me, you could tell that I like to eat. And the idea that the index doesn't include lunch is problematic for me. A second problem is that it's hedonistically adjusted. It doesn't pay attention to the price I paid for this computer or this microphone. It takes that price into the context of values arbitrarily assigned by the people who create the index. Finally, it doesn't include tax. Now, if I didn't have to pay tax, I guess I wouldn't bitch quite so much about the index. But the truth is that when I compile a basket of goods and services that I consume, What I learn is that the purchasing power of my savings is declining at more like 7.5% compounded than 2.6 compounded. And if that's true, then you have to look at the investment efficacy of US Treasuries. The US 10-year Treasury pays 4.4 in a currency that I would suggest is declining at purchasing power at 7.5. That means the value proposition is that the US government solemnly swears and guarantees to me that they will cost me 3% of my purchasing power every year for 10 years. In other words, after 10 years, they will give me back 65 cents in purchasing power for a dollar I gave them. This is the first promise in my life that my government has given me that I believe in wholeheartedly.
The current landscape reveals a notable shift in the financial dynamics, with increased gold purchasing by central banks highlighting a strategic move away from the US dollar. As economic uncertainty and inflation concerns continue rising, gold and silver are positioned as preferred safe haven assets. The decline in dollar reliance among BRICS nations and the growing interest in local currencies for trade indicates a significant transformation in international financial transactions, suggesting that gold's role as a stable asset is becoming more prominent. This evolving scenario reflects a response to geopolitical pressures and emphasizes the enduring value of precious metals in safeguarding wealth. How might central banks' ongoing trend of de-dollarization and increased gold investment affect individual investors' strategies in the precious metals market? Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.